In this section, we're going to discuss all about Forex. Foreign exchange, also known as Forex or FX, refers to the global marketplace where banks, institutions, and investors trade and speculate on national currencies. The Forex market is by far the largest and most liquid financial market in the world, with an estimated average global daily turnover of more than $6.5 trillion, which has risen from $5 trillion just a few years ago. This is larger than the stock market and cryptocurrency market combined. I mentioned a term called liquid or liquidity. Liquidity simply means the ability of a currency pair to be bought and sold without causing a significant change in its exchange rate. A currency pair is said to have a high level of liquidity when there is a significant amount of trading activity for that pair. A market's liquidity has a big impact on how volatile the market's prices are. Volatility in Forex trading is a measure of the frequency and extent of changes in a currency's value. A currency might be described as having high volatility or low volatility, depending on how far its value deviates or changes from the average. Going back to liquidity, lower liquidity usually results in a more volatile market and cause prices to change drastically. Higher liquidity usually creates a less volatile market, in which prices don't fluctuate as drastically. Another characteristic of the Forex market is that it is open to buy and sell currencies 24 hours a day, 5 days a week. Another critical feature of the Forex market is that there's no central marketplace or exchange in a central location, as all trading is done electronically via computer networks. This is known as an over-the-counter OTC market. Now, let's look into Forex trading. Forex trading is the process of speculating on currency prices to potentially make a profit. Currencies are traded in pairs, so by exchanging one currency for another, a trader is speculating on whether one currency will rise or fall in value against the other. The value of a currency pair is influenced by trade flows, economic, political, and geopolitical events, which affect the supply and demand of Forex. This creates daily volatility that may offer a trader plenty of trading opportunities. Forex can be traded using online trading platforms provided by brokers that enables a trader to buy and sell currencies using a mobile phone, a laptop, a tablet, or a PC. There are 3 different types of Forex market: spot Forex, forward Forex, and futures Forex. Spot Forex market is the physical exchange of a currency pair which takes place at the exact point the trade is settled, i.e. on the spot, or within a short period of time. While forward Forex market is where a contract is signed or agreed to buy or sell a set amount of a currency at a specified price to be settled at a set date in the future or within a range of future dates. Future Forex market is where a contract is agreed to buy or sell a set amount of a given currency at a set price and date in the future. Unlike forwards, a futures contract is legally binding. Most traders speculating on Forex prices will not plan to take delivery of the currency itself. Instead, they make exchange rate predictions to take advantage of price movements in the market. Now, let's try to understand what is a base and quote currency. A base currency is the first currency listed in a Forex pair, while the second currency is called the quote currency. Forex trading always involves the selling of one currency in order to buy another, which is why it is quoted in pairs. The price of a Forex pair is how much one unit of the base currency is worth in the quoted currency. Each currency in the pair is listed as a 3-letter code, which tends to be formed of 2 letters that stand for the region and 1 standing for the currency itself. For example, GBP USD is a currency pair that involves buying the Great British Pound and selling the US dollar. So in the example below, GBP is the base currency and USD is the quote currency. If GBP USD is trading at 1.35361, then 1 pound is worth 1.35361 US dollars. If the pound rises against the dollar, then a single pound will be worth more dollars, and the pair's price will increase. If the pound drops, the pair's price will decrease. So in actual trading, if you think that the base currency in a pair like Great Britain pound, in this case, is likely to strengthen against the quote currency, US dollars, you can buy the pair, or what we refer to as going long. If you think the pound will weaken or fall against the US dollar, you can sell the pair or go short. When this happens and the direction at which you buy or sell is correct, then you could earn a profit. We will go into more details later as to how you could buy or sell a currency pair using a broker's trading platform in future lessons. In the meantime, I hope that you now have a good understanding of what the Forex market is and what Forex trading entails. I will see you soon in the next video.